The Basics of Finance. Chapter 2. The Secondary Market. A secondary market is one in which financial instruments are resold among investors. Issuers do not raise new capital in the secondary market, and therefore the issuer of the security does not receive proceeds from the sale. Trading takes place among investors. Investors who buy and sell securities on the secondary market may obtain the services of stockbrokers, entities who buy or sell securities for their clients. We categorize secondary markets based on the way in which they trade, referred to as market structure. There are two overall market structures for trading financial instruments: order-driven and quote-driven. Market structure is the mechanism by which buyers and sellers interact to determine price and quantity. In an order-driven market structure, buyers and sellers submit their bids through their broker, who relays these bids to a centralized location for bid matching and transaction execution. We also refer to an order-driven market as an auction market. In a quote-driven market structure, intermediaries, market makers, or dealers quote the price at which the public participant trade. Market makers provide a bid quote to buy and an offer quote to sell, and realize revenue from the spread between these two quotes. The market makers derive a profit from the spread and the turnover of their inventory of a security. There are hybrid market structures that have elements of both a quote-driven and order-driven market structure. We can also classify secondary markets in terms of organized exchange and over-the-counter markets. Exchanges are central trading locations where financial instruments trade. The financial instrument must be, though, listed by the organized exchange. By listed, we mean the financial instrument has been accepted for trading on the exchange. To be listed, the issuer must satisfy requirements set forth by the exchange. In the case of common stock, the major organized exchange is the New York Stock Exchange, NYSE. For the common stock of a corporation to list on the NYSE, for example, it must meet minimum requirements for pre-tax earnings, net tangible assets, market capitalization, and number and distribution of shares publicly held. In the United States, the SEC must approve the market to qualify it as an exchange. In contrast, an over-the-counter market, OTC market, is generally where unlisted financial instruments trade. For common stock, there are listed and unlisted stock. Although there are listed bands are typically unlisted and therefore trade over the counter. The same is true of loans. The foreign exchange market is an OTC market. There are listed and unlisted derivative instruments. Market efficiency. Investors do not like risk, and they must be compensated for taking on risk. The larger the risk, the more the compensation. An important question about financial markets, which has implications for the different strategies that investor can pursue. It is, can investor earn a return on financial assets beyond that necessary to compensate them for the risk? Economists refer to this excess compensation as an abnormal return. In less technical jargon, we referred to this in Chapter 1 as beating the market. Whether this can be done in a particular financial market is an empirical question. If there is such a strategy that can generate abnormal returns, the attributes that lead one to implement such a strategy is referred to as a market abnormality. We refer to how efficiently a financial market prices the assets traded in that market as market efficiency. A price efficient market, or simply an efficient market, is a financial market where asset price rapidly reflect all available information. This means that all available information is already impounded into an asset's price, so investors should expect to earn a return necessary to compensate them for their anticipated risk that would seem to preclude abnormal returns. But according to Eugene Farmer, there are the following three levels of market efficiency: 1. Weak form efficiency, 2. Semi-strong form efficiency, and 3. Strong form efficiency. In the weak form of market efficiencies, current asset price reflect all past price and price movement. In other words, all worthwhile information about historical price of the stock is already reflected in today's price. The investor cannot use that same information to predict tomorrow's price and still earn abnormal profits. In the semi-strong form of market efficiency, the current asset price reflects all publicly available information. The implication is that if investors employ investment strategies based on the use of publicly available information, they cannot earn abnormal profits. This does not mean that price change instantaneously to reflect new information, but rather that asset price reflect this information rapidly. Empirical evidence supports the idea that the U.S. stock market is for the most part semi-strong form efficient. This in turn implies that careful analysis of companies that issue stocks cannot consistently produce abnormal returns. In the strong form of market efficiencies, asset price reflect all public and private information. In other words, the market, which includes all investors, knows everything about all financial assets, including information that has not been released to the public. The strong form implies that investors cannot make abnormal returns from trading on inside information discussed earlier, information that has not yet been made public. In the US stock market, this form of market efficiency is not supported by empirical studies. In fact, we know from recent events that the opposite is true. Gains are available from trading on inside information. Thus, the US stock market, the empirical evidence suggests, is essentially semi-strong efficient but not in the strong form. The application for market efficiencies for issuers is that if the financial markets in which they issue securities are semi-strong efficient, issuers should expect investors to pay a price for those shares that reflect their value. This also means that if new information about the issuer is revealed to the public, for example, concerning a new product, the price of the security should change to reflect that new information. The bottom line: financial intermediaries serve the financial system by facilitating the flow of funds from entities with funds to invest to entities seeking funds. Financial markets provide price discovery, provide liquidity, and reduce transaction costs in the financial system. Financial intermediaries not only facilitate the flow of funds in the financial system, but they also transform financial claims, providing more choice for both investor and borrower, reducing risk through diversification and reducing cost. Regulation of financial markets takes one of four forms: disclosure regulation, financial activity regulation, regulation of financial institutions, and regulation of foreign participants. Financial markets can be classified as follows: money market versus capital markets, cash versus derivatives markets, primary versus secondary market, and market structure, order driven versus quote driven. Market price efficiencies falls into three categories: weak form, semi-strong form, and strong form, and the form of this efficiency determines whether investors can consistently earn abnormal profits. Questions. Question 1. What distinguishes indebtedness and equities? Question 2. Is preferred stock a debt or equity instrument? Explain. Question 3. How does a mutual fund perform its function as a financial intermediary? Question 4. What is meant by the term maturity intermediation? Question 5. In the United States, who are the regulators of financial markets? Question 6. What are examples of money market securities? Provide a list for examples. Question 7. What is the difference between an exchange and an over-the-counter market? Question 8. What are the three forms of market efficiencies? Question 9. What distinguishes a primary market from a secondary market? Question 10. What distinguishes a spot market from a derivative market? Question 11. What distinguishes the money market from the capital market? Question 12. How does the efficiencies of a market affect an investor strategy? Question 13. The following is an excerpt taken from a January 11, 2008 speech entitled Monetary Policy, Flexibility, Risk Management, and Financial Disruption by Federal Reserve Governor Frederick S. Miskin. Innovations in financial markets have created a wide range of investment opportunities that allow capital to be allocated to its most productive use and risk to be dispersed across a wide range of market participants. Yet, as we are now seeing, innovation can also create challenge if market participants face difficulties in valuing a new instrument because they realize that they do not have any information they need, or if they are uncertain about the information they do have. In such situation, price discovery and liquidity in the market for those innovative products can become impaired. Answer the question pertaining to the statement. A. What are the information costs associated with financial assets? B. What is meant by liquidity? C. Why do you think that innovative financial products, price, discovery, and liquidity could become impaired? Question 15. The following is an excerpt taken from a November 30, 2007 speech entitled Innovation, Information, and Regulation in Financial Markets by Federal Reserve Governor Randall S. Kroszner. Another consequence of information investment is a tendency toward greater standardization of many of the aspects of an instrument, which can have to increase transparency and reduce complexity. Standardization in the term and in the contractual right and obligation of purchaser and sellers of the product reduce the need for market participants to engage in extensive effort to obtain information and reduce the need to verify the information that is provided in the market through due diligence. Reduced information cost in turn lowered transaction cost, thereby facilitating price discovery and enhancing market liquidity. Also, standardization can reduce legal risk because litigation over contract terms can result in case law that applies to similar situations, thus reducing uncertainty. Answer the following questions pertaining to the statement. A. What does Governor Kroszner mean when he says standardization reduces the need for market participants to engage in extensive effort to obtain information and reduce the need to verify the information that is provided in the market through due diligence? B. How do reduced information cost in turn lower transaction cost, thereby facilitating price discovery and enhancing market liquidity? Chapter 3. The financial system cast of characters. Financial crises are extremely difficult to anticipate, and each episode of financial instability seems to have unique aspects but two conditions are common to most such events. First, major crises usually involve financial institutions or markets that are either very large or play some critical role in the financial system. Second, the origin of most financial crises, excluding perhaps though attributable to natural disaster, war, or other non-financial events, can be traced to failures of due diligence or market discipline by an important group of market participants. Ben Bernanke, chairman of the Federal Reserve System, March 6, 2007. There is a large number of players in the financial system who buy and sell financial instruments. The Federal Reserve, the Fed, in information about the financial market that is published quarterly, classifies players into sectors. We report the broadest classification in Exhibit 3.1. The purpose of this chapter is to introduce you to all these players in the financial system, which we will do using the Federal Reserve classification by sectors. Households and non-profits are self-explanatory, so we will focus on the other sector. Another way to look at the financial system is by considering how much each sector contributes to the gross domestic product (GDP). Consider the GDP component for 2008 for the United States, as we show in Exhibit 3.2. As you can see, non-financial business contribute the most to GDP. As we discussed in Chapter 2, however, the financial sectors facilitate the flow of funds in the economy. Therefore, this sector does not produce as much GDP as the non-financial business. The financial sectors are important in the financing and investing activities of non-financial business. Exhibit 3.1, a map of the U.S. financial system. U.S. economy consists of domestic non-financial sectors and domestic finance sectors and foreign sector. Domestic non-financial sectors consist of government sectors, non-financial business, and households and non-profit. The domestic finance sectors consist of depository institutions, non-depository finance institutions, insurance companies, and investment companies. Exhibit 3.2, U.S. Gross Domestic Product 2008 show that non-financial businesses account for 72%. Federal government contribute only 4% of the GDP. State and local governments made up 8% of the total, and the rest is financial services at 16%. Domestic non-financial sectors. The government sectors. The government sector includes the federal government as well as state and local governments, government-owned corporations, and government-sponsored enterprise. The federal government. The U.S. federal government raised funds by issuance of securities. The securities referred to as Treasury securities are issued by the U.S. Department of the Treasury through an auction process. We show the amount of U.S. government debt over time and who owns this debt in Exhibit 3.3. Up until the most recent financial crisis, the major owners were Federal Reserve Bank and foreign investors. The latter include foreign government. In the last few quarters in Exhibit 3.3, you see the accumulation of government debt by depository institutions, government-owned corporations. The federal government has agencies that participate in the financial market by buying and selling securities. The federal government has chartered entities to provide funding for specific U.S. government projects. These entities are called government-owned corporations. A good example is the Tennessee Valley Authority (TVA), which was established by Congress in 1933 primarily to provide flood control, navigation, and agricultural and industrial development, and to promote the use of electric power in the Tennessee Valley region. Two other examples of government-owned corporations are the United States Postal Service and the National Railroad Passenger Corporation, more popularly known as Amtrak. In fact, of all the government-owned corporations, the TVA is the only one that is a frequent issuer of securities directly into the financial market. Other government-owned corporations raise funds through the Federal Financing Bank (FFB). The FFB is authorized to purchase or sell obligations issued, sold, or guaranteed by other federal agencies. Government-sponsored enterprise. Another type of government character entities is one that is characterized to provide support for two sectors that are viewed as critically important to the U.S. economy, housing and agricultural sectors. These entities are Government-Sponsored Enterprise (GSES) and are privately owned entities. We provide a listing of GSEs in Exhibit 3.4. There are two types of GSEs. The first is a publicly owned shareholder corporation whose stock is publicly traded. The publicly owned GSEs include the Federal National Mortgage Association, Federal Home Loan Mortgage Corporation, and Federal Agricultural Mortgage Corporation. The first two are the most well-known GSEs because of the key role that they played in the housing finance market. Both Fannie Mae and Freddie Mac have similar purposes, which are to promote home ownership through the availability of financing. They accomplish this by buying mortgage, pooling them, and selling mortgage-backed securities to investors. Because of the financial difficulties faced by both Fannie Mae and Freddie Mac, the U.S. government took control of these two GSEs by placing them into conservatorship. The other type of GSE is a funding entity of a federally characterized bank lending system and include the Federal Home Loan Bank and the Federal Farm Credit Bank. Government-sponsored corporations are often confused with government-owned corporations. An important distinction is that government-owned corporations do not issue stock to the public, whereas GSEs issue stock. Another distinction is that government-owned corporations are not operated for profit, whereas GSEs are profit-oriented. Still another distinction is that the entire board of directors of a government-owned corporation is appointed by the U.S. President, whereas only 5 of 9 directors are appointed by the President of GSEs, such as Fannie Mae and Freddie Mac. State and local government. State and local government are both issuer and investor in the financial market. In addition, these entities establish authorities and commissions that issue securities in the financial market. Examples include the New York, New Jersey Port Authorities. State and local government invest when they have excess cash due to the mismatch between the timing of tax or other revenue and when those funds have to be spent. However, the major reason why they participate as investors is due to the funds available to invest from the pension fund that they sponsor for their employees. More specifically, many state and local governments provide a defined benefit program, a form of pension, where they guarantee benefit to the employees and their beneficiaries. The 5 largest state and local sponsors of defined pension funds, referred to as public pension funds, and their size in billions of total assets as of January 26, 2009, according to Pension and Investment Czar. California public employees $213.5. California state teachers $147. New York State Common $138.4. Florida State Board $114.5. New York City Retirement $93.2. Non-financial business. Non-financial businesses are enterprises formed by individuals and other businesses to engage in activity for a profit, where these activities are not primarily those of a financial intermediary, such as a commercial bank. These businesses issue debt and equity instruments, and they invest in financial markets. Businesses participate as investors in the financial market by investing excess funds in the money market, and as with state and local government, invest the funds of the defined benefit plans in which they sponsor. The largest defined benefit pension funds of business in the United States are those of non-financial corporations. According to Pension and Investment, the 5 largest as of January 26, 2009 in terms of total asset in billions are General Motors $91, AT&T $61.9, General Electric $50, IBM $49.4, Boeing $42.5. Some non-financial businesses have subsidiaries that are involved in the same activities as financial corporations. The financial subsidiaries, which we refer to as captive finance companies, participate in the financial market by lending funds. Examples include Ford Motor Credit, a subsidiary of Ford Motor, and General Electric Credit Corporation, a subsidiary of General Electric. Domestic financial sectors. The financial sectors include enterprise that and regulators that provide the framework for facilitating lending and borrowing. We can classify these enterprises into different sectors depending on the type of transaction they facilitate. Domestic financial sector consists of depository financial institution, non-depository financial institution, insurance and investment companies. Depository institution. Depository institution include commercial bank and thrift. Thrift includes saving and loan association, saving banks and credit union. As the name indicates, these entities accept deposits that represent the liability, for example, debt, of the deposit accepting institution, with the fund raised through deposit and non-deposit source obtained by issuing debt obligation. In the financial market, depository institutions make loans to various entities, businesses, consumers, and state and local governments. Commercial banks are the largest type of depository institution and will be the focus here. A commercial bank is a financial institution that is owned by shareholders and engaged in accepting deposits and lending for profit. A bank may be owned by a bank holding company, BHC, which is a company that owns one or more banks. The five largest bank holding companies in the United States as of September 13, 2009, and their total assets in billions, according to the Federal Reserve System. National Information Centers are Bank of America, $2,253, J.P. Morgan Chase and Company, $2,041, Citigroup, $1,889, Wells Fargo and Company, $1,229, Goldman Sachs Group, $883. Bank services. The principal services provided by commercial banks are individual banking, institutional banking, global banking. Individual banking include consumer lending, residential mortgage lending, consumer installment loans, credit card financing, automobile and boat financing, brokerage service, student loans, and individual-oriented financial investment services such as personal trust and investment services. Institutional banking include loans to both non-financial and financial business, government entities, state and local government in the United States and foreign government, commercial real estate financing, and leasing activities. In global banking, commercial banks compete head-to-head with another type of financial institution, investment banking companies. In the global arena, banks engage in corporate financing that involves brokering of funds for a bank customer, which can go beyond traditional bank loans to involve the underwriting of securities and providing letters of credit and other types of guarantees, and financial advice on such matters as strategies for obtaining funds, corporate restructuring, divestiture and acquisition, capital market and foreign exchange products and services involve transactions where the bank may act as a dealer or broker in a service. Bank funding. Banks are highly leveraged financial institutions, meaning that most of their funds come from borrowing. One form of borrowing includes deposit. There are four types of deposit accounts issued by banks: demand deposit, saving deposit, time deposit, and money market demand account. Demand deposit, more popularly known as checking account, can be withdrawn upon demand and offer minimal interest. Saving deposits pay interest, typically below market interest rate, do not have a specific maturity, and usually can be withdrawn upon demand. Time deposit, more popularly referred to as certificate of deposit or CDS, have a fixed maturity date and pay either a fixed or floating interest rate. A money market demand account pay instead based on short-term interest rate. Deposit sources other than borrowing that are available to banks are borrowing by the issuance of instruments in the money and bond market, borrowing reserve in the federal funds market, and borrowing from the Federal Reserve through the discount window facility. The first source is self-explanatory. The last two require explanation. A bank cannot invest $1 for every $1 it raises via deposit because it must maintain a specified percentage of its deposit in a non-interest-bearing account at one of the 12 Federal Reserve Banks. The specified percentage are the reserve ratios and the dollar amount based on them that are required to be kept on deposit at a Federal Reserve Bank. They are called required reserve. The reserve ratios are established by the Federal Reserve Board and represent one of the monetary policy tools employed by the Fed. Banks satisfy these reserve requirements in each period by actual reserve, which are defined as the average amount of reserve held at the close of business at the Federal Reserve Bank. If actual reserve exceeds required reserve, the difference is referred to as excess reserve. Because reserves are placed in non-interest-bearing accounts, an opportunity cost is associated with excess reserve. However, if there is shortfall, the Fed imposes penalties. Consequently, there is an incentive for banks to manage their reserve so as to satisfy reserve requirements as precisely as possible. There's a market where banks that are temporarily short of their required reserve can borrow reserve from banks with excess reserve. This market is called the federal fund market, and the interest rate charged to borrow funds in this market is called the federal fund rate. Now, let's look at how a bank can borrow at the Fed discount window. The Fed discount window is charged with the lending to banks to meet liquidity needs, with the Federal Reserve Bank effectively being the banker's bank. This means that the Federal Reserve Bank is the bank of last resort. If a bank is temporarily short of funds, it can borrow from the Fed at its discount window. However, borrowing at the discount window requires that the bank seeking funds put up collateral to do so. That is, the Fed is willing to make a secured or collateralized loan. The Fed establishes and periodically change the type of collateral that are eligible for borrowing at the discount window. The interest rate that the Fed charges to borrow funds at the discount window is called the discount rate. The Fed changes this rate periodically in order to implement monetary policy